What if I told you there's a place where you could put your money that is 100% guaranteed, gives you access to the money, and you don't have to worry about any market volatility? And what if I told you that that place allows your money to compound uninterrupted and do that tax-free? And what if I told you that that place bypasses probate, is protected against judgments and liens in most states, and most importantly, allows you to use the money without jeopardizing how much you earn on the original amount you put in? Let me give you an example. Let's say you put $100,000 in an account and you took $90,000 out. You're still getting paid guaranteed interest and dividends on the full 100, while the 100 that you took out is able to go earn for you a second time. This sounds fictitious. This sounds too good to be true, right? That's exactly what I thought. When I first heard about this out in Utah, when meeting with a real estate investor, and he was telling me about his magic place where he puts his money, I was like, no way this exists. I'm a financial advisor. I know of all the places money could go and all these things he was telling me. I was thinking there's no way something like that exists. Otherwise, me, the financial advisor, would have known about it. So here's how I articulated this when I heard of all those things. When that investor who I was borrowing money from when I was in Utah, he told me he changed one thing, and that was where his money went first. And then when asked why he changed where his money went first, he told me because he was looking for guaranteed interest rate, one that never goes down when the Fed drops rates, one that is contractually guaranteed for the same amount for the rest of your life. So imagine today, you've got high yield savings accounts that are paying anywhere between 2 and 3.5%. Imagine if you found a savings account that you could earn that 2 to 3.5% that was exactly the same interest rate for the rest of your life, never changed, never went down. That'd be pretty cool, right? But after that, he told me not only does he get guaranteed interest, he earns dividends every single year. And then he said the interest and dividends I earn on the money are tax-free, and they grow tax-deferred. And then he told me I get to use that money anytime I want immediately after I make a deposit, meaning he could use that money within 30 days of making deposits. But this is where it really hit home for me, or actually where it really was like a left hook to the jaw. He then tells me, he says, and Chris, when someone like you comes and wants to borrow money, what I do is I go to my private bank, which is what he called this magic place. I go to my private bank and I take a loan and I give that money to you. And then you pay me interest on the money that I lend to you. And then I take the interest you pay me and I put it back into my private bank. I have literally created a banking system just like a traditional bank. But he then dropped the bomb. He said, but the money I took out of that private bank, it never left my account. Matter of fact, the money that I took out wasn't my money at all. I actually lent you money from a giant mutually owned insurance company. That's right. So all of my money is sitting there earning guaranteed interest plus dividends, uninterrupted compounding, while I used that money and you then paid me interest on the money, and all I did is took the interest and put it back in the place where it was. Think about that for a second. That sounds voodoo-ish. That sounds unrealistic. I mean, how in the world could he have a place, and I did allude, mutually owned life insurance company, a place where you could put money and take money from it without interrupting the interest you're earning on all of it? But you see, the problem wasn't what I didn't know. The problem was what I thought I knew that just wasn't so, and that is probably the case for most of you. So what I want to do in today's video is I want to talk about two important things with private banking systems. I want to talk about the fun stuff, the interest, the dividends, the uninterrupted compounding interest, the tax-free nature, the ability to save money and spend money at the same time, to make money twice on every single dollar. You still don't believe that this is actually real? Okay, I often have people like that, and I have to just go in and show them the numbers. So let's look at the numbers. Right here, this is an actual policy that we did for a client. Now, this is a fictitious name. We're going to call it Bucky Doe. But look at this. This is a particular client who had $100,000. And listen, don't get caught up in the numbers. The numbers can be anything you want them to be. This is just the amount that this person had. They had $100,000 sitting in somebody else's bank, like Bank of America or some other bank, and they heard that there was this place where they could get guaranteed interest for the rest of their life, plus dividends in a tax-free environment, and that's all they needed to hear. So they said, hey, I want to take the 100 grand out of my right pocket, and I want to put it in this really cool left pocket that we're talking about. And then what they wanted to do is continue saving money like they had been before, which they were saving $10,500. So take a look at these numbers. This particular person, Bucky Doe, as we're going to call them, puts $110,500 into the policy. And in the first year, they have access to, as you can see right over here, projected cash value growth for the first year of $102,187. Now, I know that's not the full amount they put in. So they do not have access to 100% of the money they deposited. They have access to, right here, 92.48%. Now, that's the worst part about this, okay? Because in the first couple years, you're not going to have 100% of the money you put in to use. But if I now knew that I've got $102,000 that I could use, and I could use that money without interrupting the interest and dividends that I'm earning on it, okay, my first thing I'd be saying is, where can I send $102,187 where it can earn money a second time? Now, let me be clear. To take money out of this private banking system, what you would do is you would take a loan from the insurance company. And yes, the insurance company would charge you interest. This particular company right now is at about 5.5% interest to borrow your money. So you got $102,000 you can use. If I take that out as a loan, I'm going to pay 5.5% to use that money. Think of this like a home equity line of credit. You have access to the equity in your house. However, when you take the equity out of your house, you pay interest, but typically you pay that to a traditional bank. Here, you're going to pay that interest back to the insurance company. So the rule of that would be is no different than a home equity line of credit. If I took $102,000 out, well, then I would need to make sure that that $102,000 can go work for me somewhere, can be invested somewhere where it earns more than the cost of capital, which is 5.5%, right? That just makes logical sense. But if I did have a place like a private lending deal on privatemoneyclub.com that I could send $102,000 and make 12%, now I'm in the money because 12 is more than 5.5%, my cost of capital. But here's the kicker. Even if I took all of that money out as a loan, and even if I had to pay interest of 5.5, nobody would care if I was making 12 and paying 5.5. But see, this policy is still paying me interest, guaranteed interest, contractually guaranteed interest, plus dividends on the full amount of cash value. So I'm making interest and dividends in this company right now is at about 5.75% I'm earning on the $102,187 while I'm out there making the spread, which is the 12 minus the 5.5. That's awesome, isn't it? But hold on, it gets even better. You see this, the second year I put $10,500 in. This is the amount that I wanted to save each year. That $10,500 goes in, and how much does that grow? Well, it grows by $12,097. So I made 15.21% cash on cash on that new deposit of $10,500. Because so if I put $10,500 in the second year, I have access to $12,097. How can that be? Well, it can be because all of that $102,187 that we took out as a loan is still earning interest and dividends. But if we keep going down every year, putting $10,500 in, look at the third year, I can take $12,811 out. The fourth year, $13,000. The fifth year, $14,000. $15,000, $16,000, $17,000, $18,000, $19,000. But hold on, right here in the eighth year, I'm no longer putting $10,500 in. Now I'm only putting $8,822 in. But that $8,822 gives me access to how much? $17,374. Folks, if you did the math, if you put $8,822 in a bank, and at the end of the year you went in and you took out $17,374, your money would have had to have grown at a rate of right here, 96.94% cash on cash return in order for that to happen. Now, doesn't that sound too good to be true? It does. But here it is. This is the impact of compounding interest. And more specifically, this is the impact of uninterrupted compounding interest. You see, this is what that person in Utah was talking about. This is what they changed. This is where they put their money. A specially designed and engineered whole life insurance policy. I was floored when I saw this. So floored that I had to do it for myself. So I ran out and I started a policy for myself. And I started using it back then to pay off debt. And I would put money in, and every quarter I would take a loan out, I would pay off debt. I would take the amount I used to pay the credit cards, whatever the monthly payment was, and I would pay that back to the policy as a recaptured loan repay. And I would rinse and repeat that cycle over and over. And in fact, I was making money twice while paying off debt. You see, the interest that I used to give away to the credit card companies that I was paying off, when I paid that amount back to my policy, that was recapturing the interest I used to give away. Yes, that's the same as making that interest rate because you're taking back what you used to give away. And all this had me so excited. So excited that all I wanted to do was run out and tell everybody I knew about this amazing private banking system, the infinite banking concepts. I did that. Now, come on. Isn't that freaking awesome? If you just listen to what I just said, if you watch the numbers I just put up on the screen, which are actual numbers from a real illustration, Bucky Doe is who we use the name of, just to shield the name of the actual client. That's freaking awesome. But here's the thing. That is not the most important part of this policy. So let me take you back in time. When I was a financial advisor early on in my career, there was this gentleman who I was introduced to. His name was Bob. Now, I knew his family, which is how I got introduced to him. He was an older man. He was an engineer by trade. He had retired. He did really well. And I was introduced to Bob because Bob wanted to put protection in place so that should anything ever happen to Bob and he should pass away, there was a death benefit that would be paid out to his wife. That was the goal. That was what he called me in for. So I went in and I did an insurance policy for Bob. But during that period of time, I did my fact finding and I found out that Bob didn't just need life insurance. To me, I thought Bob needed my help with all of his investment assets. He had IRAs, he had investment accounts, he had all sorts of stuff. And remember, Bob was an engineer, very smart man. He managed all of his own investments. But while I was having the discussion, that's what I wanted. I was a financial advisor. I made money managing assets and managing accounts like what Bob had. So I asked the question, I said, Bob, who manages all of your investments? To which Bob said, I do, and I have for a long time. And I said, Bob, would you be open for me taking a look and showing you what I could do? He said, no. I was kind of taken back. I'm like, what do you mean? No. Well, he had done so well managing them himself. Why would he have some young punk kid like myself? I wasn't a punk kid. Or yes, actually I was. Whatever. He didn't want some fancy, suited up financial advisor to manage his assets that he could manage himself. So after that, I put that life insurance in place for Bob. His wife, whose name was Beth, was now protected. But all I could think about is I got to find a way to get Bob to give me a chance. How do I get Bob to give me a chance to manage his assets? So I kept trying. I kept calling him for the reviews. And every time I'd ask him about his investments, to which he always said, no, I'm all set. But then there was this one circumstance. This one circumstance where I looked at one of the investments he had in his portfolio, and I had done a bunch of work with our consultants, and we knew that that particular position had some issues. So I brought that to Bob's attention. I said, hey, Bob, this one position you have, X, Y, and Z is about to happen. You might want to get out of that. And by the way, Bob, here's what we would recommend you put in place. So I recommended back then a high-yield bond fund, which I explained to him in nauseam because he was an engineer. He liked all the details. We went through the prospectus. He then said, well, let me research this. And I was kind of taken back. I'm like, I did all this work, all this stuff to show this. You can't just give me a shot. To no. He's going to research it. I left. It seemed like months went by, and finally, my phone rang. And I saw it was Bob calling. I answered the call, and Bob's like, hey, Chris, I finished all my due diligence on your suggestion. And you're right. I'm going to replace that position that you recommended with this new high yield bond fund, and I'll watch it for a couple months. And if it does well, I'll give you a shot. A couple months went by. Exactly what we thought was going to happen did with the position. He noticed that. The high yield bond was performing well, very conservatively. So he, when we got together again, gave me that opportunity. This is where the relationship really started. It started with a very small account. I mean, he had lots of money, and it started with this tiny little account. I spent so much time managing this account. I knew every position in there. I watched them almost weekly, and I knew that I was doing my job. Bob was really thrilled. Over time, years and years went by. Bob was a great client of mine. He gave me a little more here and there. This opportunity turned to a bigger opportunity. The next opportunity turned to a bigger opportunity. Eventually, I was managing all of Bob's accounts. Now, I was always managing Bob's accounts with him guiding the ship. He was an engineer. He always made and had the final say. Let me get to the end of the story. Bob was older, and as his health deteriorated, he came down with cancer. Everything with the accumulation plan that we had put in place changed. Bob became very concerned about protecting his wife again. Remember, we already put life insurance in place for his wife. But now what he wanted to make sure is that when he passed away, that his wife would never have to work again, and she would never have to worry about money ever again in her life. So we took all these assets that we had been managing, and we set up a distribution plan so that when Bob passed, there was a plan in place that would provide a guaranteed income stream to his wife, Betty. That income stream would never change. It would go up every year, indexed for inflation, and it was not tied to any market. She didn't have to look at it, didn't have to care whether the market went into a recession, which eventually it did. She had a guaranteed income. That day did come, and I remember it. I had been there 2 weeks prior. Bob was in his same recliner chair, but he looked very frail. I knew the time was near. And when I got the call, it came as no surprise, but it hit me hard. You see, Bob had become a friend. He wasn't just a client. He was somebody I deeply cared about. I cared about not just Bob, but also his wife. I had gotten to know them very well. So when he passed, it hit. It hit me very hard. But I'll never forget. I did the paperwork to process that death claim on that life insurance policy that he had in place. And I remember the day I called Betty up and I said, Betty, I got something I have to bring to you. I didn't tell her what it was. I came out and I sat at their kitchen table as I did so many other times. And I opened up an envelope and I handed her a check for $200,000. This check was the life insurance proceeds for that policy that we put in place so long ago. When I handed that to her, she had no idea how much this policy was. See, Betty didn't do any of the finances. That was Bob's job. Betty took care of the house, made sure Bob had meals, like so many families operate today. That check to her told her how much Bob cared for her, but also made her know that she'd never have to worry about money again. On top of that, I explained to her that she'd be getting a check every single month for the rest of her life. And every year, that check would go up because it was indexed for inflation. She broke down and cried, and I cried right along with her. You see, what I'm trying to explain to you is all that returns, all that infinite banking stuff, it's all great. While you're living, it's going to do wonderful things for you. But all of us will have to realize we are not here forever. There will come a time where we all have to go on and graduate and go on to heaven. And when that time comes, the death benefit will be the single most important thing. So let me take you back over to this illustration that we were talking about a little bit ago that I got you super excited about all the cash value growth, the ability to make money twice on every dollar, the ability to grow your money tax-free and tax-deferred. None of that matters when you're in your final hours. The only number you're going to stare at on this fancy specially designed and engineered whole life that you've used for your private banking system is this number right here, the death benefit. And this death benefit in day one was $1.5 million and change. And then we drop a term rider off in the 8th year, which is why the premium deposits went from $10,500 down to $8,800. We dropped $1.2 million in term. So the death benefit drops down to $439,000, but it quickly climbs and climbs and climbs over time. So let's come down here. If I'm not mistaken, Bob was in his 80s. So right around here, let's go to 85 years old and let's highlight this line. At 85 years old, the death benefit in this policy is $1,028,888. And every year that death benefit goes up. It goes up because the policy's dividends keep building it through paid up additions. Now you don't need to understand that, but just know that every year that death benefit goes up as the cash value goes up. That number right there will be the only number that you care about when you're in those final weeks, those final days, those final hours. Because that is the number that will make sure that your family will be taken care of when you're no longer here. You know, I do such a good job of teaching the infinite banking concept, showing people how to take back control of their money, showing them how to get a guaranteed return on their money, make money twice on the same dollar, all that stuff. But you know what? At the end of the day, I've delivered more death benefits than I can count. I've watched and witnessed the impact that life insurance had on those families. I've seen it firsthand, not just Bob, but there's countless stories where I've delivered checks to widows and their children. And they at that moment knew that they'd be okay. Because everybody else that showed up at their doorstep came with an open hand waiting for a check to be given to them. The funeral home, the people that own the cemetery, the flower shop, everybody needs a check paid to them. The life insurance is the only check that's going to be paid to that family that just lost a loved one. The reason I wanted to do this video is I wanted to put more emphasis on the single most important part, the death benefit. At the end of the day, this is life insurance. Specially designed and engineered, yes, but this is life insurance. And someday that death benefit will be the single most important thing to you, even though you will no longer be here. Because you will know that you left something that will take care of your family. Hopefully, will take care of your family for the rest of their life. Even if it's not for the rest of their life, it will make their life easier, allow them to stay in the home, allow them to maintain their lifestyle. Let's get our priorities straight, folks. Let's realize what really matters when we do this and focus on the one number that nobody wants to talk about, because that number, the death benefit, comes with the cost of insurance. But I have never met somebody that was at the end that cared about that cost of insurance. All they cared about is the fact that they took the time and the energy to start that policy many, many years ago. Because at that moment, they know their family, their loved ones, the ones they care about, will be taken care of. With that being said, thanks for joining me for this. Go out there and become your own bank. Take back control of your money, and we'll see you on the next one.